Hi, good morning. Thank you for coming to our webinar today. My topic today is building a resilient investment portfolio with safe haven Singapore stocks or ETF. My name is James, market strategist at uSMART Securities. This event is part of the Singapore's Trading Festival program in partnership with SGX. Okay, sorry, I see some questions here. Okay, so and we are also giving out $15 cash voucher as well for this event. If you are assisting uSMART customer, we would like to reward you with the $15 cash voucher. All you need to do is provide us with your uSMART ID at the end of the webinar in the Q&A box. So our event will last for about 30 minutes. So probably like 10:20, you can start putting in your uSMART ID, and then we will issue you the $15 cash vouchers to your uSMART account within 5 working days. And upon receiving the cash voucher in your trading account, you can redeem it by executing one trade on SGX, be it buy or sell. If you cannot remember your ID, your uSMART ID is okay, because you can also provide me your email or handphone number in the Q&A box in this Zoom webinar. And what you type in the Zoom Q&A box will not be shown to others, so do not need to worry about that. If you do not have an existing uSMART account with us yet, you can still provide me your name and email, but please also open the account in 1 week time and also email us at this email address, support@usmart.sg. And then once you receive the email, we will issue you the cash voucher. Let me begin with some disclaimer first. This presentation is for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. Okay, I see some question here saying that you have not keyed in your uSMART ID in the last webinar. So probably you can key in now. Yeah, so we will take note of that. So let me show you how to create a resilient portfolio. And I will also explain what go into it as well. So first of all, understanding yourself in terms of risk profile, investment horizon, and investment objective. But in today's sessions, I will not go through with you individually what is your risk profile and investment objective and etc. You need to decide yourself. But if you do not really understand yourself, I would suggest you to construct a conservative portfolio first and slowly adding more risk into your portfolio, but not the other way around. For example, if you just build a high risk, aggressive portfolio first, and then the market tank, you may want to de-risk later by selling some of the risky asset and buy into some safe haven asset. You'll be cutting losses first and then use the little money left to invest in more into safer asset and hope that this safer asset can make up the losses, which is not so advisable because safer asset won't give you huge return that you may see in a risky asset, or the safer asset itself, right, could also take more time to help you recover the losses. All in all, understanding yourself is a long self-discovery journey. For example, when I first came out of university, I only trade futures, specifically commodity futures and index futures. 2 years later, I began investing in local value stocks, and then I started to include unit trust and in ETF in my portfolio. But over the past few years, my portfolio mostly consists of growth stocks that I don't really buy value stocks anymore because probably I have built enough. Secondly, you also need to make market assumption. For example, if you are constructing a global portfolio, you need to make ample assumption about the stock market outlook in US, China, and Singapore, or whichever country you intend to invest in. For example, I would say that the banking crisis is not as serious as the Lehman Brothers crisis in 2009. So if there is some contagion that causes our local bank stocks to sell down, I would say that it is a good time to accumulate. So this is the assumption that I make to myself. Thirdly, you need to choose the right portfolio strategy. In this case, since we are looking to build a resilient portfolio, so I would say that the strategy would be diversifications. I will share more diversifications strategy along the way. So to start building a diversified, resilient portfolio, first of all, you need to look at your risk profile to decide whether you are a conservative, balanced, or aggressive investor. If you are a conservative investor, it means that you cannot take a lot of risk. You want to diversify into safer assets with lower volatility, and hence you want to own more bonds, lesser equity. You can also choose to invest 20% in equity in this case, and 80% in bond as a conservative investor. For a balanced investor, normally I would say that it would be 50-50 split in equity and bond allocations. Aggressive investor could mean investing 80% in equity and the remaining 20% in bond. But this is just an example. If you want to invest 100% in equity as an aggressive investor, you can do so. Or you think to yourself that you are a conservative investor, you just want to own 100% bond, you can do that as well. Assuming we are building a resilient Singapore portfolio, so the most direct and most simple way to do so is by creating a pure ETF portfolio. So in this example, for simplicity's sake, we will just choose one bond ETF and choose one stock ETF. So let's talk about the bond ETF first. Since my objective today is to create again the Singapore portfolio, so I will try to only include Singapore bond. Normally there will be two choices for me. Number one, ABF, Singapore Bond Index ETF. It is a bond ETF that benchmark against iBoxx iBoxx ABF Singapore Bond Index. And basically it comprises Singapore dollar bonds issued by Singapore government or Singapore government linked entity. So the top 10 holdings show you here that it all consists of a high quality, safe Singapore government bond. Number two, you can also consider Nikko AM Singapore dollar investment grade corporate bond ETF. The investment objective here is may look quite complicated to you or to me as well, but to put it simply, it invests in large cap investment grade bond. The top 10 holdings are all good names like Temasek, HSBC, UOB, NTUC, Changi Airport, Aviva itself. But in this example, I will just use ABF Singapore Bond Index Fund as the bond component. Ticker code would be SBIF. So in a conservative portfolio, you will be investing 80% of your money into this bond ETF. In a balanced portfolio, 50%, and in an aggressive portfolio, 20% itself. So why you want to have bond ETF in your portfolio? Because first of all, it helps you achieve portfolio diversifications. I am not a person who likes to invest in a single company bond, but I often view that the risk is too high to invest in a single company bond. So bond ETF again will help you gain exposure to many different company bond and to help you to achieve the purpose of diversifications. And it also helps you with portfolio diversifications as well, because it is a totally different asset class to equity. So bond is relatively less risky, less volatile. It typically has a low or negative correlation to the equity market. So when equity market goes down, there could be some flight to safety mentality where people favor bonds. So instead of going down in prices together with equity, bond prices may go up. But you may also see that bond is also hurt in a rising interest rate environment as well. So this is why you see many articles stated that 2022 was the worst year for 60-40 equity bond portfolio, because bond has an inverse relationship with interest rate. Interest rate go up, bond prices go down. But I believe that 2023 would be an appropriate time to invest in bond, because US interest rate is reaching the terminal rate. This actually implies to us that the downside risk for bond is limited, and we are also likely to witness a decrease in the interest rates soon. So on a side note, the major disadvantage of bond is that since they are safer asset, you should not expect a high return for bond. You should only expect a lower return, typically lower than equity itself. In any case, if you want to build a resilient portfolio, a bond can be a good addition to help you cushion the portfolio ups and downs. Other than bond, I think everyone should also start to include gold to replace part of your bond weightage itself. So for example, if you are holding a balanced portfolio with 50% allocation to bond, you may consider 15% in gold and the remaining 35% in bond. So why gold? Because historically, gold outperformed equity during stock market crisis itself. So I know that a lot of investors will tell you that gold is inflation hedge. But to me, the main purpose of having gold in your portfolio is to hedge against market crash. For example, during the COVID-19 market crash, S&P 500 fell by 34%, gold fell by 5% at most. And the gold ETF listed on SGX has two share classes, Sing dollar share class and USD share class. Stock codes are GSD and GLD respectively. Next, let's focus on the stock component. Here I put down STI ETF. I think if you are a lazy investor, you can just invest in STI ETF and call it a day. You can consider your investment work done by investing in one equity ETF, which is STI ETF itself. So why STI ETF? Because it comprises of large cap, blue chips company. It has 30 companies in the index itself. The top 3 holdings are bank stocks, DBS, OCBC, and UOB, and contributing to 47% weight in the index. And the STI index ETF provides investors a much a stable dividend return. The indicative dividend yield is about 3.7% itself, and the data here that show you 4% is a bit outdated, but if you invest in the ETF itself, it's about 3.7%. Okay, and if we were to look at the price earnings ratio, the PE ratio itself is one of the lowest in the region. STI index PE ratio is 13 times. For Hang Seng index is about 13 times as well. Shanghai Composite is 14 times. S&P 500 is 19 times. all in all, what I like to share here is Singapore stocks as a whole is being viewed as defensive asset allocations, higher dividend yield, and cheaper in terms of valuations itself. So to a lot of active fund manager out there, I would say that Singapore stocks to them is sometimes a place to park their asset if they want to have some defensive asset allocation. But if they want risk-on exposure, they will still go back and invest in Hong Kong, US, or the European country itself. So coming back to the slides, if you do not like STI ETF, what other stocks you can consider including in your portfolio itself? So some of the individual stocks may include Singapore bank stocks. I would say that it's one of the best alternative to STI and helps you achieve diversifications and to build a resilient portfolio itself, be it DBS, OCBC, or UOB Bank. I know a lot of you may have already owned bank stocks and quite familiar with the fundamental side of things. So I hope I still can impress upon you that I can share something new to with you as well. So probably the question I want to pose to you is, do you have enough bank stocks? Firstly, bank stocks include DBS, OCBC, and UOB. DBS is the largest with market cap at 85 billion. And one of the reasons you should like them is that they give you stable dividend yield between 4 to 5% dividend yield. And I previously conducted 2 or 3 webinars to China audience in the capacity of SGX Academy speaker. Bank stocks was always the topic that I'll introduce to them. I believe bank stocks is the most resilient stocks in SGX. And oftentimes when I talk to clients, one of the investment idea is, instead of thinking about investing in STI ETF, you can just choose to put your money in any one of the bank stocks itself. Because in longer term, be it 3-year, 5-year, 10-year, 15-year, or 20-year annualized return, any one of the bank stock here outperform STI index. For example, the 3-year annualized return for DBS is 26%, meaning to say for the past 3 years, every year your return on DBS is 26%. For OCBC is 18%, UOB is 20%, but for STI it's just 13%. And if you look closer into the yearly return since 2007, of all 16 years, DBS outperformed OCBC, UOB, and STI over 10 calendar years, which means if you invest in DBS, 62% of the time you end the year with the best performance. And the volatility is probably between 17 to 18% for bank stocks. STI is 13%, indicating bank stocks are quite volatile. But the maximum drawdown for bank stocks over the past 10 years was 43 to 47%, and negative 39% for STI index. All in all, even though bank stocks are more volatile than the STI index, the maximum drawdown itself is not really that far apart. But bank stocks typically can provide you the better return, like so much better. This is why I would say a lot of active funds like unit trusts here, they with Singapore fund mandate, they tend to have a higher weight in all these banking stocks. And if you were to ask me which bank stocks is the best, my personal favorite is DBS because it tends to outperform others bank stocks. But DBS is also the most expensive in terms of PB ratio. It's quite high at 1.5 times. OCBC is 1.05, UOB is 1.2. But personally, I don't mind investing in DBS with the highest valuations because I always think that it's expensive for a reason. I think that if you want to invest in DBS, you need to accept the fact that PB ratio for DBS represented in white line here is higher than OCBC and UOB since 2018 itself. On a side note, if you believe that the banking crisis will intensify, that will cause the share price and the PB ratio to drop, you can look out for the PB ratio to drop to 1 time. I would say that investors often want to accumulate banking stocks when the PB ratio is near or lower than 1 time PB, like 2008, 2016, and 2020 itself. So look out for PB ratio at 1.1 or 1 for better entry price. And I would say that you probably would not go too wrong investing in any one of the bank stock here. Even though I like DBS, I also find that the institutional investors that I talk to, their favorite is probably OCBC and UOB. And I guess they like them better because they are cheaper in terms of valuations. But if you cannot decide, one way that I can share with you is that you can actually invest in all of them. So you also achieve the purpose of diversifications. And since the lot size is 100 shares, so to own them all require probably about minimum $7,500 itself. But I also want to share with you that bank stocks are not exactly risk-free. You can argue that now we are near the end of the economic cycle. Bank, which typically is cyclical in nature, will underperform during recessions. You can also argue that there would be some contagion in the banking crisis. So the next one to drop could be the US mortgage, the US commercial loan. But my investment thesis is if US really goes into a recession, it could be just a mild recession, or it could probably be, I would say that it is a bit unlikely that US mortgage and commercial loan will go into big trouble since the loan exposure of startup and tech companies is the main one that face problem, but not the broad-based industry is facing problem now. And all the while, the asset quality of Singapore bank is good. This is why their PB ratio is more expensive than other regional banks like China banks. For China banks, their PB ratio is less than 1, but we are typically more than higher than 1 PB ratio. But investors here are willing to pay a premium to own them, to a premium in terms of valuations for those high quality local banks, because we know that the asset is also high quality as well. And I also think that the Singapore bank asset quality may only worsen slightly in 2023 because the rate hike that we see so far is still orderly, and we do not see rising borrowing costs affecting the borrower's repayment ability yet. And bank stocks against have ample provisions to cushion against the credit risk, and the NPL that we see is still quite healthy at 1.1 to 1.6% for all those banking stocks. And here I also want to show you the Singapore bank loan exposure. The pink color bar here is the percentage of the non-performing loan contributions, and the white bar here is the operating profit contributions. So here show you the China loan exposure. This is the Southeast Asia loan exposure, and this is the Singapore loan exposure itself. So being Singapore banks, naturally the loan exposure as a percentage of the operating profit in white bar here is high in Singapore. For example, the Singapore loan exposure as a percentage of operating profit is near to 70% for DBS, whereas the Singapore loan just contribute to about 50% of the non-performing loan. To put it simply, what we want to see here is high operating profit contribution loan exposure not having any problem at all. Meaning to say, we should see low non-performing loan contributions. But if this is the other way around, like what we see in China or Southeast Asia, that we see that the high percentage of the non-performing loan contribution is higher than the percentage of operating profit contribution is okay. Because in this example, it actually tells you that this country like China and Southeast Asia are providing weak risk return. But it's okay because these countries, right, is having low contribution to the operating profit itself. But the high profit operating profit contribution in Singapore are not having a major problem because the NPL contributions is low. So my point here is Singapore banks are more resilient than what you think. In any case, the entire brouhaha in the banking world may benefit local banks as local banks may win over the private banking clients and family office since the global banking crisis started. And probably the next one that I would like to introduce you that I think is also quite resilient would be CICT. So CICT is CapitaLand Integrated Commercial Trust, is the largest REITs listed on SGX with 21 properties, and the total property value is 24 billion itself. So is again, Singapore REITs is resilient because it also gives you a stable dividend yield itself. In terms of the portfolio, like office portfolio, they own Capital Tower, Capital Green, Asia Square 2, and some office tower in Germany and Australia as well. And I also see that more people returning to office in Singapore. For example, the physical occupancy in Singapore is 70% plus, where other countries like Australia is like 50% to 60%. In terms of retail mall, they own Bugis Plus, they own Bugis Junction, Clarke Quay, and integrated development include Capital Spring, Funan, and all of these, right, are prime locations, high quality asset. But basically, the investment thesis is quite simple. There will be more normalization in business activities since the removal of COVID-19 measure, and since more workers are working from office now, we should also see continuing rental reversions. So the office portfolio here show you that we are seeing positive rental reversion at 7.6% in 2022, which is quite impressive. The occupancy rate here is 96%. And one thing I like about CICT is the CBRE research shows you that Grade A office rent is now 11.7 Sing dollars per square feet, which is the highest since first quarter 2009 itself. Yeah. So probably we'll skip a bit. And it is also predicted that the overall rental rent in terms of retail rents itself, right, will continue to recover itself with the China reopening, that we should see higher tourist arrival number as well. The shopper traffic has not yet gone back to the pre-COVID level, but the tenant sales itself, right, is already higher than the pre-COVID level. And we are also seeing that there would be limited retail supply for the retail mall supply for the next 3 years. The average annual supply is 0.5 million square feet for the next 3 years, a relative average 0.6 million square feet in the past 5 years itself. So some other safe haven stocks may include Sheng or the defensive asset allocation like Parkway Life REITs, which is a healthcare REITs, or Pure Singapore Exposure Hospitality REITs, Far East Hospitality REITs as well. But unfortunately, due to time constraint, I'm not able to share more in detail with you. But maybe let me quickly go through some of the key investment thesis for Sheng, which is my favorite consumer stable stock. Sheng is a founder-led company. It belongs to consumer staple sector, so naturally it's defensive in nature. It's recession-proof, as we witnessed back in 2020. It has good cash flow. The dividend yield is about 3.7%. They have a dividend payout mandate at 70%. The gross profit margin is 29%, last I checked. The PE ratio is now about 19 times. But if you were to look back, pre-COVID average was around 22 times. So I think you may see higher price for Sheng itself due to some PE expansion, multiple expansion. Okay, and that's all I want to present today. Before I move into Q&A, I'd like to remind you that you should start leaving down your uSMART ID or your email or your address or your handphone number in the Q&A box itself. And then we will then issue you the $15 cash voucher based on the detail that you given to us within 5 working days. If you do not have an uSMART account with us yet, please still provide us your name and email, and also open the account in 1 week time and email us at this email address. We will then issue you the cash voucher. Yeah, I see a lot of questions coming in. Please keep them coming in. Okay, what is the dividend for bond? It depends on whether you invest in company bond or you invest in the bond ETF itself. I would say sometimes it could be 2%, sometimes it could be 3%, or some of the high yield bond, it could be like 5% dividend yield itself, depend on which one you invest into. Are we able to access this recording for review? Yes. I will post the webinar replay on the YouTube channels in the next few days at the latest. Yeah. So next question, how likely Singapore will go into recessions? Okay, it's a good question. I would say that the definition of technical recession is 2 consecutive quarters of negative GDP growth. So the GDP number for Singapore is still positive, so we are not in a recession yet. But Singapore economy is also trade dependent, so we also need to look at how are China and US are doing as well. So at this point, we could probably rule out that China will go into recession this year. But if US, on the other hand, goes into recession this year, I would say Singapore is likely to face a recession as well. And currently, I see that US may go into a mild recession or a shallow US recessions, if that ever is. So all in all, having said that, I would say that if Singapore really goes into a recession, it will be mild, because I would say that China may be able to save the world economy and US recession may be quite shallow. Okay, another good questions here. Any opinion on Singtel? Okay, I have not been looking at Singtel for a while now. So I think that the mobile landscape for the past 10, 20 years has changed a lot. Like a few years ago, a lot of analysts are saying that they are quite excited about the growth in the mobile data revenue. But nowadays, there is basically nothing much to be excited about. I keep waiting for a bump in revenue in local communication stocks like Singtel, M1, and StarHub due to the 5G adoptions. But unlike China, the 5G adoption in Singapore is slow so far. This is probably why the China communication stocks like China Mobile, China Unicom, China Telecom went up a lot in the past maybe 3 to 6 months time in terms of share prices on the Hong Kong Stock Exchange, but not here. I would say that Singtel, StarHub do not really follow the same telecommunication stock momentum in Hong Kong. And lately, I would say that the Hong Kong communications, the telecommunication stocks are having some multiple expansion as well, which the PE ratio expanded, but it's not happening in Singtel and other telecommunication stock here. So I'm a bit disappointed. So basically, I don't think Singtel is a good investment per se. It is quite disappointing over the years. Probably I do not study enough to really like Singtel, but at the moment I don't really see that is good secondary revenue stream here for Singtel. And I would say that the dividend yield is probably 4%. So should you like Singtel because of the dividend yield at near to 4%? Probably not, because I would say that you might find much better, stable REITs company that can earn you the 4% dividend yield. Okay, could you comment on Sing dollar? Okay, the next monetary policy meeting is in April. So normally it will be the mid of April. I think the expectation now is that there will be further tightening, so it may cause the Sing dollar to strengthen. All in all, I would say that the bigger picture here is Sing dollar is a safe haven currency. So the outlook is quite stable and gradual strengthening. And I would say that it's always a safe haven currency in terms of the other Asian currency as well. Okay, next question would be, is Raffles Medical considered resilient to be included in the portfolio? Yes, I would say that since Raffles Medical belongs to healthcare industry is normally considered to be one of those safe haven sectors itself. I did not follow Raffles Medical close enough to give a comprehensive opinion. I would say that pre-COVID, the share price was doing about $1. Now it's about $1.4. So it has jumped out a lot, maybe due to COVID. But again, kudos for them. They managed to stay at a high price post-COVID time. So I guess fundamentally they are doing quite well. So this is why the share price jump. I reckon there will be more volatility in the first half of this year in US and in Singapore as well. So I think healthcare stocks like Reference Medical is probably one of the better good defensive options to actually help you cruise through this volatile period itself. Okay, there are a lot more questions, but please also remember to put down your uSMART ID as well. Is Reference Medical considered resilient to be included in the portfolio, which I talk about it. Yeah. So what is the best STI ETF and what is your price target, please? Okay, there are two STI ETF listed on Singapore Stock Exchange now. They are Spider STI ETF and Nikko AM STI ETF. Both of them are quite liquid. But in terms of liquidity, if you just want to invest based on liquidity itself, I would say that Spider STI ETF is better. If you were to look at the expense ratio, I would say that they are similar. The dividend yield is also similar as well. All things considered, normally I will go with the one with higher liquidity, which is Spider STI ETF in this case. I cannot remember the share price for that ETF, so I cannot give you my target price. But my target price for STI index this year is 10% upside relative to last year closing price. So I think last year closing is 3,250. So 10% upside probably is 3,575. But disclaimer here, I assume that there is no serious banking crisis contagion. Because if you were to look at the index components, right, 47% weights go into banking stocks. So if banking crisis really get out of hands, bank stocks in STI could drop, STI could suffer as well. But all in all, I would say that if you are worried, you can split your order into 2 or 3 tranches, go in different timing, or use dollar cost averaging itself. Okay, do you look into leverage ratio when you buy into REITs? Yes. I look into leverage ratio, also known as gearing ratio. So if you were asking if the leverage ratio could impact your investment decision, yes, because investors typically want to buy low gearing ratio REITs itself, because the maximum gearing ratio is 50%, and they normally want to buy the REITs with a low gearing ratio because they will see that the REITs has a lot more room to bump up the gearing ratio so that they can acquire more asset into their portfolio. So this is why you do not want to buy into a high gearing ratio REITs, because you may need to worry about their debt servicing ability. And a lot of REITs manager here also know that investor like you or me hate to look at REITs with high gearing ratio. So this is why if you look at a lot of REITs out there in Singapore, right, typically their gearing ratio is 35% on average, if I'm not mistaken, or 37% on average, which is maybe 10-15% of their maximum gearing ratio at 50%. Yeah, so I think this is okay. Next question is, between Reference Medical and Parkway Life REITs, which one do you think is better? To me, it's Parkway Life REITs. I like their asset more. I think the asset quality is top notch. Just to give you a short answer. Okay, there are a lot more questions, but maybe let me answer one last questions. And you can keep the question coming. I will try to answer them when I post the video on YouTube itself. So I'll be posting the video soon, in maybe latest by Tuesday. So let me answer one final question. So, okay, this is a complicated question. So REITs returns quite poorly in the past few years. Will they be good return moving forward? Okay, it's a good question. So as we all know, REITs has not been performing that good for the past few years. I think the best return year is 2017 or 2018 itself, where I think on that year they have maybe 22% total return for the S-REIT ETF. But I would say that at this point of time, if you are investing in REITs mainly because of the dividend payout, REITs at this point of time, I don't think it will give you good capital return, meaning to say you should not expect much from the price appreciations. But along the way, maybe there is some good AEI, asset enhancement initiative, and the REITs also buy into new property and put into the portfolio itself, then it can give you some price appreciations. On a side note, okay, I think there is something interesting happening in the Hong Kong REITs industry that caught my attention that I would want to share with you, that I would say that it could bring some outside potential for REITs company going forward. That I think that going forward, the REITs business model may change a little bit, because recently, if you were to look at what Link REITs is doing, so Link REIT is basically a Hong Kong listed REIT company, and it's the largest Asian REIT company that they are actually announcing REIT 3.0 strategy that I think some of the Singapore REIT company can probably learn from this. To put it simply, Link REITs in Hong Kong, they will try to buy more properties to put into their asset, the portfolio, with the funding of other capital partner. For example, they will buy a Singapore property and they probably will just own 25% of the property, and the remaining 75% will be owned by other entity, by other partners itself. But the property itself will be managed by Link REITs. This way, Link REITs is able to invest and own more properties quickly with other people funding. And on the same time, it can also grow its property management income. So to me, it's almost like an asset-like model. So you can include more properties in your portfolio with other people funding, but on the same time, you can earn more in terms of property management income. So I think it's an interesting business model where REIT company can own more property on the same time, actually take more property management income itself. So I think this can bring a really good valuation expansion to REIT company if you decide to adopt this business model. So I think it's an interesting development for that companies, and I don't know whether Singapore company, REIT company want to follow that as well, but this is a good price return strategy in terms of capital appreciation to me. Okay, so I think I managed to answer some of the question, but not all. But unfortunately, we run out of time. And again, let me say that I will post the video on YouTube. I will answer some of the questions here in the comment section once I post the video. Lastly, thank you for coming. You have a good weekend. Do follow us on Telegram or our YouTube and subscribe to us as well. Thank you. Subscribe to our YouTube, and happy trading, happy investing. I will see you soon. Thank you all. Thank you.